Hey there, welcome back to my channel, it's me the Mind Injector. In this video we're going to delve deep into the world of NIO stock. There's been a whirlwind of news surrounding NIO recently, some good, some not so good. So, is it time to go bullish on NIO? Well, stick around because we're about to break it all down. Before we dive into this video guys, I've got some exciting news for you. I want to introduce you to Moomoo Financial. If you open a brokerage account with Moomoo and deposit at least $1 using the link in the description, you'll get a chance to draw a free stock worth up to $2,000. But that's not all. If you make a net deposit of $100 or more, you'll receive not just one, but 5 free stocks worth up to $2,000 each, plus free premium courses to help you sharpen your investing skills. And if you're really serious about investing, you can deposit $1,000 or more and get a whopping 15 free stocks, bringing your potential earnings to a staggering $30,000. So, sign up for a Moomoo brokerage account using the link in the description and start earning those free stocks. Now, let's jump into the main content of this video. First things first, let's talk about the latest developments. And I've got to say, it's been quite a rollercoaster ride for NIO investors. But the latest news is definitely leaning towards the positive side. Does this mean it's time to jump on the NIO bandwagon? Well, not so fast. You see, in the latter half of 2022, we were a bit skeptical about NIO's growth potential, but the latest delivery data has certainly turned some heads. In August, NIO delivered a whopping 19,329 vehicles, marking an 81% increase compared to the same month in the previous year. That's impressive, no doubt. It's also the second consecutive month of robust performance, which is a clear sign that something's happening. Now, some might be thinking that NIO is back in the growth zone. But, before we get carried away, let me put on the brakes a bit. It's crucial to remember that the stock market can be as unpredictable as the weather, and past performance doesn't guarantee future success. So, why the caution? Well, there's more to the story. One reason for this surge in sales growth could be the launch of new vehicles in recent months, like the ES6 electric SUV this summer. While it had an impressive start, sales could taper off. And let's not forget about the looming shadow of the Chinese economic slowdown, which could rain on NIO's parade. But here's where it gets really interesting. While sales are surging, NIO stock doesn't seem to be following suit as strongly as you might expect. This could raise a few eyebrows. You'd think a surge in deliveries would send the stock skyrocketing, right? Well, not necessarily. One significant factor to consider is NIO's fall in gross margins. In the last quarter, the company's vehicle margins dropped to 6.2%, a far cry from the 16.7% in the same quarter the previous year. That's a pretty big dip. Now, you might attribute this to falling sales during that period. But here's the kicker. Even if the deliveries keep growing, falling margins might continue to be a thorn in NIO's side. Why? Well, back in June, NIO decided to join in on the Chinese EV price war. This might have contributed to the recent sales boom, but it also means that NIO's vehicle margins might not see much improvement in the near future, and without significant margin improvements, NIO could continue struggling to narrow its net losses and move towards consistent profitability. In other words, it might remain on a downward trajectory. But before we get too gloomy, let's take a look at some of the factors in favor of NIO. For one, there's a strong demand for electric vehicles in China, and NIO is holding its own with approximately 10% of the market share. China's EV market is massive and still growing, which gives NIO a solid advantage. Now, here's where NIO really shines. It's pioneering battery swap technology. This unique feature allows drivers to quickly exchange depleted batteries for fully charged ones, making NIO vehicles not only convenient, but also setting them apart from the competition. And NIO isn't just stopping in China. It's making moves to expand into Europe and other global markets. This strategic decision opens doors to larger customer bases and is a significant boost to the company's growth prospects. Speaking of expansion, NIO is classified as a growth stock, and it's not hard to see why. The company has set an ambitious target of reaching annual sales of 1 million vehicles by 2025. That's some serious growth potential right there. But it's not all sunshine and rainbows for NIO. There are some significant challenges it needs to tackle. First up, the competition is fierce. Tesla, BYD, XPeng, they're all vying for a piece of the EV pie. And that could make it tough for NIO to maintain its market share and profitability. Then there are those macroeconomic factors. The global economy is facing some headwinds, including rising inflation and interest rates. These factors could potentially dampen the demand for electric vehicles, which, of course, would hurt NIO's sales. And let's not forget about regulatory risks. The Chinese government is tightening its grip on the electric vehicle market, and that could pose some serious challenges for NIO. Stricter emission standards and limitations on new licenses for EV manufacturers are just a couple of potential hurdles. Now, let's dive into the financials. NIO hasn't quite reached profitability yet, and it's unclear when that might happen. The company is burning through cash, and that raises questions about how long it can sustain its losses. In fact, in the first quarter of 2023, NIO experienced a significant decrease in its gross margin, dropping to just 1.5%. Compare that to 14.6% in the first quarter of 2022 and 3.9% in the fourth quarter of 2022. That's a substantial hit to profitability. Also, the vehicle margin didn't fare much better, coming in at 5.1% for the same period compared to 18.1% in the first quarter of 2022. This dip in vehicle margin was primarily due to changes in the product mix and increased battery costs per unit. Now, if we look at NIO's earnings performance over the past 4 quarters, it's a bit of a mixed bag. In the first quarter of 2023, the company managed to beat market expectations, with earnings surpassing estimates by 13.43%. However, revenue didn't quite keep up, missing expectations by 8%. But here's where things took a bit of a nosedive. In the last quarter of 2022, NIO's earnings experienced a significant decline, missing expectations by a considerable 91.64%. Revenue also disappointed during this period, falling short of predictions by 9.63%. September 2022 didn't bring much relief either, with NIO missing earnings expectations once again, reporting a deficit of 13.20%. But there was a glimmer of hope as the revenue surprised positively during the same period, beating expectations by 0.73%. The second quarter of 2022 saw another earnings miss, with a deficit of 10%, but the revenue managed to compensate somewhat, surpassing predictions by 4.70%. Now, let's get to the big question. Is NIO stock a good investment? Well, that depends on your investment goals and risk tolerance. But if we look at the last 4 quarters of earnings, NIO stock does show promise for those seeking growth potential. Advantages include the company's potential to benefit from the growing EV market, its progress in reducing costs and moving toward profitability, and its strong management team. However, there are disadvantages to consider too. NIO faces stiff competition from other well-established Chinese EV makers. It's yet to achieve profitability, and its stock can be quite volatile. Now, let's talk about the big dreams. Can NIO stock reach $100? It started the year strong, but it has since taken a sharp dip. However, there's still potential for it to rise. But reaching $100 isn't going to be a walk in the park. First, NIO needs to focus on expanding its business, increasing production capacity, and advancing technological innovations. Second, the overall electric vehicle market needs to keep growing, and NIO must capture a significant market share. Lastly, improving investor sentiment is crucial for a stock price rebound. So, while it's possible, it's not guaranteed. NIO has some work to do, and the market can be unpredictable. In conclusion, NIO is a company with a lot of potential, but it's not without its challenges. The recent surge in deliveries is promising, but it's not a guaranteed path to success. Falling margins and intense competition are significant concerns. So, it might not be the right time to go all in on NIO stock just yet. As the excitement about recent sales fades, margin worries could intensify, and that could push the stock even lower. This is it for this video, guys. Thanks for watching, and please make sure to subscribe, like, and leave a comment down below.